Good morning, guys. It is Friday, November 1st, 2024. This Bathrobe business. I got the coffee and I got the news. So I have a really interesting story to share with you guys today. There was a fantastic interview that I found a couple days ago from Paul Tudor Jones, who's a major investor on Wall Street. You've probably seen him on CNBC, Bloomberg over the years. He gave a fantastic interview, and I've kind of just been re-listening into it a couple of times, just kind of forming the ideas that I had around it. Because I think he makes a lot of great points. Whenever you have something where there's a ton of interesting information, you kind of have to digest and process and really think about it. So that's why I haven't shared it on the channel yet. I think I discovered this video on Tuesday or Wednesday. So I want to go through that video with you guys right now because I think it's really defining the next 10 years of America. Not to say that he's an oracle, not to say that he's a prophet, but I think everything he outlines is very in line with the policy that I think all administrations are going to take in the next 10 years. So it doesn't matter if we're seeing a Harris or a Trump presidency. I think there is some truth to everything he's saying. Now, both of them are very opinionated candidates, so I don't think they're going to be as austere as some of the stuff he's recommending. But let's jump into it and we'll kind of play it as we go. So I'm just going to jump into the video. Hopefully I don't get a copyright strike for this. So we'll see if this actually works. So let's do it.
I'm saying that to just to get us to the point where we stabilize the GDP where it is right now, here's what you need to do. You need to let the Trump tax cuts expire. That's $390 billion. You need to raise the payroll tax on every single working person, 1%. That's another big slug. You need to.
What do you think that does to jobs?
We're clearly going to have a period of contraction, which hopefully, that's what I was going to say. It's going to be really important for the Fed to be able to offset the fiscal contraction area that's going to come.
Then you want to increase the individual tax rate all the way to the top rate of close to 50%.
Now, hold it.
Yep.
I don't want to do any of this stuff. What I'm telling you is that we've got to be serious about where we are fiscally. And so I'm giving you, there's a whole set of options, right? We could go in and cut 25.
Okay, I'm just going to pause it right there. So essentially what he's saying is that debt has gotten to a point where we have to get serious about it, and that there's no way to get out of debt other than taking a lot of these measures. So he's talking about broad tax increases. So he's saying he's going to allow the tax cuts to expire, which I think they expire in 2026. So even coming into the next presidency, regardless of if it's Trump or Harris, I think the next one is still going to be a full year of the existing Trump tax cuts. Those are set to expire, I believe, in 2026. Now, Trump's coming in and saying that he wants to drop taxes even further. He wants to go from 25 to 15. That may or may not happen. However, I think he's completely right that if we do that, we're going to see massive increases in debt. So he's saying increasing it across the board. So letting the tax cuts expire, raising total individual tax rate 4%, 4 tiers by 10%, to the top one being 49.5. Now, remember, this is federal. This does not take into account state and local taxes. So you're talking about the top marginal tax rate, 49 federal. In addition to state and local taxes, you could easily be at a 65% tax rate on the top tier of income. Now, a lot of people say, oh, that's the billionaires. No, not necessarily. That's starting with a lot of professional industries. So you're going to see a lot of doctors and lawyers paying a lot of money in taxes, especially the more successful you are, obviously, the higher you're paying. Now, I'm not making an argument against taxes. I'm just simply defining what he's defining. In addition, he's talking about raising Social Security and Medicare. I don't know if he mentioned in that snippet, but during the course of the interview, he is raising the tier on Social Security from 65 to 70. He's talking about raising individual tax rate, payroll tax rate, about 1% on every individual. And let's see if we can find that chart again. Raising payroll tax by 1% and applying to all wages, and increase the corporate tax rate from 21 to 25%. So this is a massive, massive tax increase. It would probably be the biggest tax increase we have seen in modern history. We're going back to post-war, post-World War II, where we saw tax rates this high in order to get debt down. So let's jump back into it. I think he's right. I think he's very right with the fact that we have to get serious with our debt. And the only way you get serious with debt is you have to start making higher payments. I mean, this is no different than when you have a credit card. The only way you're going to pay off the credit card is by getting above what you're spending on it. So let's jump into the next section and let's analyze this. And I'm going to give you kind of a broad stroke analysis towards the end. Let's jump to the next part here. 1 second. Okay, here we go.
Things, means test, Medicare. If you do all these things, all you do is you get to a primary balance. What that means is you stabilize debt to GDP. You're still actually increasing your debt.
Right.
You're still actually increasing it because it excludes the interest cost, which, oh, by the way, the interest bill this year is larger than every single line item except Social Security. It's larger than defense spending, larger than Medicare.
I want to talk about why you're here, which is Robinhood, and this conference. But before we do that, is this, given all the things you're saying, are you off buying gold and Bitcoin? And
I think all roads lead to inflation. We're going to end up,
so does all roads lead to inflation, therefore gold is a good investment? Is Bitcoin a good investment to you?
I'm long gold, I'm long Bitcoin. I think commodities are so ridiculously underowned. So I'm long commodities. I think most young people find their inflation hedges via the NASDAQ. That's also been great. It's probably some combination.
Okay, I'm going to pause it right there. All right, so he said a lot of good things here. So he's essentially saying all roads lead to inflation. I think he's absolutely right. This is one of the advocacies I've been making on this channel, is that inflation is kind of baked into the model at this point. Now, there's two things you can draw on this. The first is, well, actually, let's finish the next section of the video, and I'll give you my overlying opinion on it. We have just one more section, so let's jump into it, and then I'm going to give you a breakdown of everything that I think. So here we go. 1 second.
Every 100 basis points is worth about 90 billion a year to the deficit. 90 billion. So yes, if we're trying to stabilize debt to GDP, we want to run the most dovish monetary policy that we can without letting inflation become too much of a tax on the citizenry. So yes, all roads lead to inflation. That's historically the way every civilization has gotten out, is they've inflated away their debts.
Okay, so that's the video. So what's he saying? So essentially he's saying that we have to inflate away he's saying it flat out, we have to inflate away the debt, and that every 100 basis points is $90 billion off of the federal budget. So he's essentially saying that no matter what happens, we're going to have to inflate away this debt. We're going to have to essentially devalue the currency so much that we can actually pay off the nominal price of the debt, while at the same time increasing tax flow so that we actually have the funds to do it. That's really dangerous for multiple reasons. Not only are you going to enter a period of maybe hyperinflation is the wrong word, because hyperinflation technically means something else, but you're going to enter a period of incredibly high inflation rates with a powerful contraction due to restrictive taxes. You're going to enter a period of stagflation, essentially. This is one of those cycles that is incredibly, incredibly difficult to break. And he's not wrong. This is why inflation is so dangerous, is because once you start inflating away your currency, it starts a cascade where the reversal becomes very difficult to get out of. And if we do this, it will pay off the debt. But what the U.S. economy is going to look like at the end of it is unknown. He's also essentially saying that because of this, interest rates are going to keep getting cut. And it makes complete sense because they have to find a way to pay this debt off because they simply can't afford it. Now, one of the problems I have with this argument is this is requiring people, especially the United States government and the United States populace, to be incredibly logical, calculated, and disciplined. And that is not who we are. We got into this mess because we are not disciplined, because we are sloppy, because we overspend. We waged global wars in, I don't know, every country on the planet: Iraq, Afghanistan, Syria, Europe now. We spend like psychopaths, and we are not people that are disciplined. So if we do start cutting interest rates, it is not going to lead to the austerity and to the contraction that he is describing. It's going to cause people to start spending more. So that's why I argue, even though I think he's completely right on the tax rate, and nobody obviously wants to pay more in taxes, but I think he's right on the tax rate. I would argue that it is wrong to cut interest rates, as I always do on this channel, that it is going to lead to more spending because the federal government does not actually behave in a disciplined manner, especially when you consider who's coming into the office. Regardless of who the next candidate is, Harris or Trump, they're both big spenders. And I can't imagine a scenario where you're going to get Donald Trump not to spend free money. But you are going to have a scenario where no matter who comes in, they're going to spend money like crazy. That will spur some growth. There's no question to that. But I don't see these tax rates going to where they need to be. And I don't see the contraction in spending that I think he's envisioning. The other argument I will make is China is no longer buying the debt like they used to. So I'm going to share this tab with you guys. So China's holding of U.S. Treasury securities has decreased drastically over the years. This article is a couple months old, but it's a trend that's obviously a decade old. So in about 2009 is where it begins. They increased their holdings, and now they're pretty much back to the same level that they have been. As I report on this channel, they are like Paul Tudor Jones are buying a lot of commodities. They're investing heavily in gold as a hedge against inflation and as an asset reserve. So what's going to happen when now China is not the only country that buys U.S. debt. Technically, Japan has always been a bigger buyer of U.S. debt, but still, you're talking about two of the biggest debt holders in the United States, and one of them is no longer doing it. What happens when there's no one to buy the debt? Well, that's when the Fed is going to step in and start buying U.S. bonds again, quantitative easing. However, if BRICS trends continue and if Japan's economy continues to slow, the U.S. Fed is going to have to step that up at a drastic rate. And if that happens, that's where you can enter a state of hyperinflation, because essentially we've gotten rid of all facades. We're just printing money at that point. One of the ways that the U.S. economy controls inflation is through taxation means and through this mechanism of bond selling. It's technically printing money, but it is doing it in the form of debt payments. And so because of this magical smoke and mirrors trick, it doesn't equate directly to just turning on the printing press and putting money into people's accounts. So there is some facade that is controlling interest. Controlling inflation. But what happens when all facades aside, the Federal Reserve is just buying all of these holdings? Well, that's where you really can enter a state of hyperinflation. And I don't think having 10% higher tax rates is going to offset it, which, again, I don't think is going to happen, period. So that's why this is so concerning to me, is the next 10 years, I think inflation, like I've kind of said on this channel before, is going to be the standard. And that's also not taking into consideration things like reshoring. I'll say my second point for a second. So I think inflation is going to bake in to the U.S. economy. So that's why I keep pushing things like gold. I'm not a crypto guy, but I definitely see the value of it as a hedge against inflation, because I think no matter what, when we get these PCE numbers that I report, and I'm going to report another one here in just a second, I don't think they're actually reflecting what is happening in the market. They're looking at supply chains and seeing costs go up and down and saying, look, inflation is down. But inflation is much bigger than that. Inflation is the cost of commodities. It is the cost of assets. It's the cost of equity. It is the monetary M1 money supply, M2 money supply. These are macro forces. These are not micro forces. So when you look at these numbers and say, oh, look, PCE is down, or PPE, I don't remember even all the terms. They're down to 2.1% versus 2.3% last month. None of that matters. None of that matters. What matters is stuff like this, where they're printing money and they're consuming an immense amount into spending. And that's what's really going to drive inflation and interest rates. Now, one devil's advocate point I will make on this. One thing I don't think Paul Tudor Jones takes into consideration is the Laffer curve. And that's simply the fact that if you increase taxes to maybe not I think to the levels that he is saying, you are going to see drops in actual returns on those taxes. So usually with the Laffer curve, the more you cut taxes, the more revenue comes into the government, because it stimulates the growth of the economy. So I think that the contraction of the economy is going to offset any gains you make in that tax rate. This is the devil's argument of what he's saying. I don't know how much I agree with that. I think there is definitely a point in the Laffer curve where taxes get restricting. Perhaps those are the levels, perhaps they are not. But I do think he does not talk about the Laffer curve in that assessment. So that's everything I want to talk about in regards to that interview. I'm just going to hit the next stories rapid fire because we're getting kind of long on this one. The PCE data came out yesterday. So yes, inflation according to PCE is down to 2.1%. It's one of the lowest levels. Yay, congratulations. U.S. consumer spending is beating expectations. So U.S. consumer spending is up drastically. Consumer spending, which accounts for more than 2/3 of U.S. economy activity, rose 0.5% last month. This is for the month of September, after an upward revised 0.3 gain in August. So we're seeing, like we've reported on the channel before, very strong consumer sentiment, very strong consumer spending. And so we're probably going to see a very strong retail market this coming holiday season. Last story, last two stories. U.S. jobless claims fall as hurricane distortion fades. So it's essentially saying that very few people filed for unemployment. It dropped 12,000 to a seasonally adjusted 216,000, and the Labor Department was forecasting about 230,000. I'm sorry, I just realized I'm not sharing my screen with you guys. Sorry, idiot. And then this is the most perplexing story of the day. So a couple of days ago, I reported you guys ADP numbers that showed that the U.S. economy was, the payroll numbers had added something like 122,000 jobs to the U.S. market. Today, the Labor Department came out and it said it was actually only 12,000 jobs, down sharply from September and below the Dow Jones estimate of 100,000. The unemployment rate did hold steady at 4.1%, but I don't understand how you get such a differently revised number, such a stark difference. I mean, like I said, ADP and the Labor Department have not been congruent on their numbers for a while now, but the trends have always been the same way. So this is really weird that we had 112 reported by ADP, but only 12,000 reported by the Labor Department. Now, the article does talk about the fact that it's probably due to the hurricane and to the strikes at Boeing. I think that. I don't know. I have trouble believing that seems like a pretty powerful disparity to cause that much of a difference. But that's what the article is talking about. And as always, all the links to the articles are in the description below. So I hope you guys liked today's video. I hope it wasn't too boring for you. I know we went a little bit over on time. I hope you guys have a good weekend, and I'll see you guys back here on Monday. Bye.